this video we are going to learn about the two rules. Now, if you haven't fully understood our structure rules, please go back to that video before moving on to this one. So the two rules is the whole, well, it is the edge. The two rules itself is the edge. We use it for our market direction, our bias. We also use it for our entries. So all our models, everything is based on these two rules. So let's explain what the two rules actually are. So we know that the markets don't exactly move from, that wasn't smooth. We know that the markets don't move from A to B just like that, right? We know that's not the case. And we know that the way that we usually taught is we know that price doesn't just go create new highs, new lows, as smooth as that. We know that as well. We know that the way that price moves is quite random, in the sense that you'll get random highs, lows in between, and then you'll get that impulse and so on. Okay, I don't know why I don't know why it's like that. I've never had it like that, but anyway. Okay, let me make this a bit thicker. There we go. Okay, so this is what we generally see how the market moves. Now, how do we fit the two rules around that? So we already know our structure rules, but there's also a difference between understanding minor and major structure. So minor structure and major structure, the only key difference is, for example, when we create the range from the low to the high, anything that happens in between that range is classed as minor structure. As soon as the structural high has been taken, that creates that new major structure range. And again, anything that happens in between is all minor structure. Now, depending on the model you use, we generally tend to promote the use of major structure unless you're following James's model. For any of my models, I always use major structure. That is one of my rule sets, and that does not change whatsoever. However, for James's model, there is a slight discrepancy in that. The rule set remains the same. It's just the fact that they're using minor structure, but you'll learn that later on in the course anyway. So let's try and learn and explain the two rules in a clearer setting. Okay, so let me just draw. Let's start off with having a bullish trend, and I don't know why it's done that again, but anyway. And that will do. Again, let's go there and there. Okay. So our two rules. So initially what we need is the first break of structure, which happens here. So you got a break of this structural range, and that creates this high. This high is what we call the intent. And intent essentially means it's the intention that price is going to go bullish. However, price is not confirmed until we have a second break of structure. To keep things as simple as possible, essentially the best way to see it is that we need two breaks of major structure to confirm whether price is bullish or whether price is bearish. Because effectively what can happen is when price is in a trending move, sometimes you may have what we class as just a break of structure, and then price would just continue going bullish. But just because there's one break, it doesn't mean that price is going to turn bearish at that stage. So that's why we've narrowed it down to having simple two rules. Okay, and that is again fully tied in and based around our structure rules. Okay, so what we have here is the intent. So that is rule number one. Rule one. And then following that, once we have the second break of that major structure, which we have here, we have rule number two. Now rule two is what we call, let me go there. Rule two is what we call a successful retrace, or otherwise known as the SR. And the intent is also sometimes known as the IM. The reason why is IM is because we call this the impulsive leg. And when we start talking about order blocks, we call whatever the OB is there, that is going to be our IM OB. Or when we talk about the SR, that's going to be our SR OB. Now, the reason why we use this, the two rules, it ties down everything that we do here at Vertex. In terms of the entries, it's all going to be based around the two rules, because we only ever going to have two entry points. We're only going to ever have two POIs at max. depending on the situation, but we shouldn't have any more than that. So that means that we've narrowed down all the possible standard SMC POIs that you can have to just 2. Okay, but that's the basic rule set. So effectively it's 2 break structures, and that confirms whether price is bullish. Okay, and for bearish it's the exact same thing going the other way. So what I'll do is I'll do the exact same thing for you just to clarify it. So let's have rule number 1 and rule number 2. So in this case what we have is we have the first break of structure, assuming that price was coming from there. For the first break of structure, which causes the intent, and this is the IM, and then we have the second break of structure which breaks that major structure, and that is created by the successful retrace, which is the SR. The reason why we call it the SR is because it was the retrace that successfully broke the intent structure. It's literally as simple as that. Anything that happens in between, for example, say there's a bullish structure break here, a bearish structure break here, this is irrelevant. This is minor structure which will not confirm your change in trend. Okay, we only focus on major structure, and that is the key thing to remember in terms of identifying trend. However, again, the discrepancy will come if you use James's model, which is the only difference, but the rule set remains the same. The only reason you use minor structure in that scenario, and you'll understand it once you start learning it, is because it's based on the session structure, not the overall structure. Whereas what I'm trying to teach you is the overall structure as the market as a whole, not just a set period. Okay, so effectively it is 2 breakthrough structures that we're looking for. That will confirm whether price is bearish or whether price is bullish. Now the 2 rules will be revisited throughout the course, and what we'll do, you'll see everything slowly coming together in terms of tying the structure rules, the 2 rules, and our entry drills. And once we tie that all together, you'll see the 2 rules in play and how it all comes together and creates our overall edge. But these 2 rules is essentially the edge on its own. What I suggest that you do is go back to the structure video, start practicing marking structure, and then on top of that, start practicing marking your 2 rules. So your 2 rules, how to mark it. What I'll do is I'll show you a chart, and we'll start marking our structure out again. I won't go through the whole process of marking out the highs and lows because that's already done, but I'll explain where the 2 rules and how you can identify it, and then it's for you to put into practice. So in front of me we have the 1 minute time frame on EU. The reason why I'm using the 1 minute for this is purely because you'll probably see the changes in trend is quicker than as opposed to the higher time frame where you'll see like overall trend. So it's easier for me to show you this, and it will show you how to identify obviously the changes in trend, which is what you'll need to be able to do anyway. So let's start off with the initial range that we have here. So prices previously bearish, and we've gone on to form this range low from this range high, and then what happens is we have this breaker structure which creates where's the high being confirmed? The high gets confirmed on this one here, which creates this range from this range high to this range low here, and then we have this breaker structure. Now that's this breaker structure. So what we have is we have rule number 1, and then we have rule number 2. So now this confirms a bullish trend. So we continue following a bullish trend until, because we end up being in this range. Oh, actually a good thing to mention. So we continue following a bullish trend. However, this is a good thing to see is we have a bearish break here. All that is, this is only intent. So this is our rule number 1. But this does not confirm a bearish trend unless we have a break of that low. But what actually happened is, in this case, we had a break of that high and price continued bullish. It's only at this stage, from this high to this low, we had this break again. So we had intent. Following that intent, we had rule number 2, which gave us, was it this candle? Yeah, we had rule number 2, which from this candle high to this candle low, which gave us bearish confirmation. And then from there we had another bearish move from there. Now on the minute time frame, you can't always expect huge moves, especially, to be fair, given that this is December, it is quite rangy at the moment. But what you'll see, the difference on the higher time frame is the exact same thing, but you'll see it on a bigger scale. What tends to happen with price is that the way that price moves is that you'll get these ranges, and then you'll get these impulsive moves. Now in this case is where you see the two rules, and then what will happen, it will settle for a bit, it will range, the same thing will happen again, and then it will come back down and will form a cycle, and it will just continue going in that cycle round. Alright, however, we don't necessarily need to worry about that. The only time it will get confusing is when you have, for example, is when you have, say you have the initial two rules here. So you know that price is bullish, but then you have a bearish break here. Okay, that's only intent, but then you have another bearish break. What do you do in this case? Key rule to remember is that we only follow what immediate price is showing us to determine our trend. So it may seem a little bit awkward in the case that we have the initial two rules, price is bullish, but then we have now we have two bearish breaks. So what do we follow? Is it bearish or bullish? We will follow what the immediate price is showing. However, when we talk about entry points, there is a slight change that we can add in terms of when we start talking about invalidation. You'll understand when we can interpret this in a different way. Another way that this can get confusing, right? If we have, for example, we have two bullish rules, okay, then price comes and then comes to break this one. What do you do in the case where, do we have an example actually? Yeah, what happens is if it continues breaking here. So what we have now is intent followed by intent. When this happens, price tends to enter a sideways range before continuing in whichever direction it is. Do not worry too much about that. Just worry about having the two rules to determine your trend and direction. However, when we start talking about entry models, it's not necessarily required to have always the two rules in place. For example, one of my models is solely based on trading off intent. However, the two rules will determine the probability of the trade that you're having. Obviously, the two rules, because it confirms the trend, it does give you a higher probability of a setup. However, there's ways around it where we can use the two rules to our advantage in order to increase the probability of the setup. Now, what I suggest doing is going on to whatever time frame you wish to go on. It's up to you, but I suggest going on time frames that you can comfortably read structure. So again, you shouldn't be on this video if you don't understand structure just yet. And just marking out your structural rules and then marking out the initial intent and the successful retrace. Because what happens after that, say for example you got the initial bearish wherever it is, so that was the high, where's the low? The low in this case is all the way here. So we have break of structure here, and then we have break of structure here from this high. Then whatever happens after that, it's not necessarily important. However, say if we're in this case where we're trying to find a trade within here, and we look up and see the price is already confirmed to be bearish, so we know our direction, our bias, our pro trend even, is bearish. So just focus on it, marking out the initial move, and then mark out where the transition happens, and then get used to seeing that. The main thing with mechanical trading is observing the frequency of the pattern and having that as a visual reminder in your head. Now, the best thing that you can also do is take screenshots of any examples that you have them near you, so you always have something back to refer to if you ever need. It'll go to the point where you'll see the two rules without even marking any structure, without marking anything. You could just glance at a chart and you already know whether price is bullish or bearish. However, you should never be in the position, where you are asking, is it bullish or bearish? And you should never be asking me if price is bullish or bearish. If you are, then you don't understand the two rules just yet. And I'll refer you back to this video if you do ask me that question. And that's the whole beauty of having a mechanical edge, is purely because everything that you do can be answered by, have these rules been met? Has the structure rules been met? Has the entry rules been met? But I hope this video was useful. Before moving on to phase 2, I suggest that you fully understand what phase 1 was about. So these are the only two videos, was the two rules and the structure video, which was video number 1. So before moving on to phase 2, be sure that you understand what the two rules are, and be sure you fully understand the structure rules and are able to comfortably mark structure on every time frame that you wish to trade. And then from there you can move on to phase 2. If you don't do that and you start rushing and go jump to phase 2 and then jump to phase 3, you will struggle for phase 3 when you start talking about entries if your understanding of two rules is incorrect, and you're also going to struggle if the understanding of structure is incorrect. But for now, I hope you enjoy, and I'll see you in phase 2.